I would describe the US dollar's reserve currency status as somewhat secure, but not invulnerable. There are multiple ways to evaluate its position. Most currencies primarily function within their domestic economies. The Egyptian pound, for example, is largely used inside Egypt. If foreign investors suddenly lost confidence and sold their holdings, Egypt could face a currency crisis, especially if it lacked sufficient foreign exchange reserves to stabilize its currency. This type of vulnerability applies to most nations, with only a few major exceptions. The United States, however, occupies a different position. Beyond voluntary global demand for dollars, there is also structural and relatively inelastic demand. One major reason is the enormous stock of dollar-denominated debt held outside the U.S. Estimates suggest roughly $18 trillion in offshore dollar liabilities exist, much of which is not owed to American institutions. For instance, a Brazilian firm may borrow in dollars from a Chinese lender. Neither party is American, yet the obligation is denominated in dollars. This vast eurodollar system forms a dense and interconnected web of loans and financial contracts. When debt is denominated in a specific currency, demand for that currency becomes difficult to unwind quickly. Borrowers could default, but doing so damages creditworthiness and cuts off future financing. Because so many entities simultaneously owe and hold dollar assets, a powerful network effect has emerged. Dismantling such a system would be slow and complex, more like steering a massive container ship than flipping a switch. Any meaningful shift away from dollar dominance would likely unfold over decades rather than through a sudden collapse. Discussion around the BRICS bloc often centers on reducing reliance on the dollar. While countries such as Russia and China increased trade settlement in local currencies following sanctions related to the Russian invasion of Ukraine, broader adoption faces structural constraints. For example, India imports significant energy and defense equipment from Russia, resulting in Russia accumulating large rupee balances. However, the rupee does not offer the same global liquidity or investment flexibility as the dollar. One of the dollar's greatest structural advantages is the unmatched depth and breadth of U.S. capital markets. The United States hosts the world's largest and most liquid financial ecosystem, from equities like the S&P 500 to corporate bonds, real estate, private equity, and venture capital concentrated in Silicon Valley. Dollar holders have a vast array of opportunities to deploy capital efficiently. In contrast, many alternative markets are smaller, less diversified, constrained by capital controls, or supported by weaker legal frameworks, factors that limit their currency's global attractiveness. Historically, after World War II, the United States accounted for over 40% of global GDP, held most of the world's gold reserves, and possessed the only intact large-scale industrial base. The dollar became the global reserve currency largely by default. Over time, as other economies rebuilt, and the U.S. share of global output declined to roughly 15-25%, depending on measurement, the structural basis for dominance naturally eroded. Yet, reserve currency status tends to persist long after peak fundamentals, due to powerful network effects similar to how a mature social platform remains relevant, because users are already interconnected. Today, no country occupies the uniquely dominant position the United States held in the immediate post-war period. China is economically significant but does not replicate the same structural conditions. Europe remains economically large but politically fragmented. The extraordinary U.S. dominance after World War II may have been historically exceptional. What we are witnessing could be a gradual normalization toward a more decentralized global system. In this environment, neutral reserve assets are regaining attention. Gold's share of global central bank reserves declined for decades after World War II, but has been steadily rising for more than 20 years. Around 2009, central banks shifted from being net sellers to consistent net buyers of gold, reinforcing its renewed strategic role. Meanwhile, Bitcoin has emerged as a potential neutral reserve asset and settlement network, with some smaller nations experimenting cautiously. Rather than a single fiat currency replacing the dollar, the future may be multipolar. Gold may play a larger stabilizing role. Bitcoin may expand as a parallel settlement layer. Bilateral trade agreements in local currencies may increase. China may settle more trade in yuan with key partners. India and Russia may continue direct settlements. Regional blocs may diversify away from the dollar without